Welcome back to The Explainer. Today, we're stepping into the totally fascinating, incredibly high-speed, and frankly high-stakes world of single-stock leveraged ETFs. We're going to unpack a pretty intense financial instrument, the Direxion Daily AAPL Bull 2X ETF, otherwise known by its ticker AAPU. Look, if you love the adrenaline of modern market trading and really want to understand the tactical tools the pros use, you are exactly in the right place. So, let me start by asking you a pretty simple question. How would you like to double the daily returns of one of the absolute most famous, heavily analyzed, and widely traded tech stocks on the planet? Seriously, if Apple has a good day, you have a great day. Sounds incredibly tempting, doesn't it? Well, that is the exact promise of APU. This ETF is strictly engineered to provide one very specific outcome, which is 200% daily leveraged exposure to Apple's price movements. Meaning, if Apple's stock goes up 1% on any given trading day, this fund aims to go up 2%. It's just a supercharged, high-octane way to interact with a market giant, all without actually having to pony up the cash to buy double the amount of underlying shares. Okay, let's dive into our roadmap for today. We're going to cover what AAPU actually is. Then we'll look at the day trader advantage, the volatility drag trap, why you need to be aware of tail risk, and finally, the mathematics of leverage. Starting right off with Section 1, what is AAPU? Let's pop the hood and see how this thing is built. According to the FactSet analyst report, APU doesn't just go out and buy a massive physical mountain of Apple shares on traditional bank margin. Instead, it manufactures this 2x exposure after fees and expenses, of course, using financial derivatives called swap agreements. Think of these basically as synthetic side bets with big banks. They're explicitly designed to artificially multiply the investment results, but only on a day-to-day basis.
Section 2. The Day Trader Advantage. Why are active traders so obsessed with this?
Imagine a day trader wakes up with massive, absolute conviction that Apple is going to surge today. They have a few options, right? They could use traditional margin trading to borrow money and buy more stock. The problem is, traditional margin trading carries infinite risk. If the stock unexpectedly craters, you can lose significantly more money than you initially invested, and boom, you get hit with a devastating margin call. APU, on the other hand, gives traders a really unique structural advantage. It strictly caps your maximum loss to the full amount you invested. Now, you can absolutely lose 100% of your money if things go disastrously wrong, but you cannot lose 110%. For a day trader taking aggressive, highly leveraged positions, that capped downside is just a massive psychological and financial relief.
So you can see AAPU is purely a short-term tactical tool. It delivers that 2x daily price return and caps your max loss, which makes it absolutely perfect for day traders who have high conviction on daily momentum. But the trade-off here is massive added volatility because you're putting all your chips on a single company's daily movement. Think of AAPU kind of like a high-performance drag racing car. It is built for a short, incredibly aggressive sprint on a straight track. But what happens if you take that drag racing car and try to drive it on a bumpy cross-country road trip? Section 3. The Volatility Drag Trap.
The FactSet report is completely explicit about this danger. They warn that purchasers holding shares for longer than a day will need to monitor and rebalance frequently. Let me really emphasize that point. It aims to deliver 2x returns for a single day only. It literally only performs as intended when Apple is trending cleanly in one direction and you happen to guess that direction right.
If you try to hold it in a choppy, sideways market, you're going to fall victim to volatility drag, which is sometimes called volatility decay. Basically, this is the tendency of volatility to continually impair your investment returns over extended periods of time. And remember, we're talking about a single stock leveraged ETF here. Individual stocks are inherently way more volatile than broad market indexes, so this drag effect is dramatically amplified. To really wrap our heads around why this decay happens, there's a great quote from an academic paper by Matthew Krauss in the Journal of Mathematical Finance. He notes that most leveraged ETFs rebalance leverage daily and have to, quote, buy high and sell low each day to keep their leverage ratios fixed. Just think about the mechanics of that for a second. Because the fund has to reset its 2x exposure at the end of every single trading day, it's mathematically forced into doing the exact opposite of what we're all taught to do. It buys after the price has already gone up and sells after it's gone down. It literally has to do this just to maintain its internal math. So in a sideways market, this daily forced rebalancing simply grinds your capital into dust. And while volatility drag is essentially a slow bleed, it isn't the only danger. Section 4. Beware of tail risk. Tail risk is the sudden wipeout. It's the risk of a dramatic one-day loss that greatly diminishes your compound return. In the world of leveraged ETFs, it can potentially result in the complete long-term liquidation of the fund. We're talking about a black swan event here, a terrible earnings report, a sudden regulatory crackdown, some crazy macroeconomic shock, something that causes a massive overnight drop. When you're leveraged, a huge drop doesn't just sting, it can instantly obliterate your portfolio. You'd need massive, sometimes mathematically impossible subsequent returns just to break even again.
To see the absolute devastation of tail risk in the real world, let's look at some data on 3x leveraged European products from that same academic paper. Look at April 20th, 2022. Netflix experienced a massive one-day stock decline of 35.1%. If you held a 3x leveraged product on that stock, your theoretical decline was 100%. The product mathematically vaporized in a single trading session. Poof, gone. Now, obviously AAPU is 2x, not 3x, but the structural vulnerability is exactly the same. An extreme single-day drop in Apple could cause catastrophic, completely unrecoverable losses.
Moving on to Section 5, the mathematics of leverage. Let's look at the actual math underpinning these massive risks.
Okay, this formula here is the second-order approximation for volatility drag, again sourced from the Journal of Mathematical Finance. Don't worry, you absolutely do not need a math degree to understand the core takeaway. This equation just proves that volatility drag isn't some market myth. It is a measurable, destructive mathematical law that actively pulls down your compound returns.
The math explicitly shows us that volatility drag is quadratic in relation to both the stock's natural volatility and the leverage factor. Because it's quadratic, taking an inherently bouncy stock like Apple and slapping a 2x leverage multiplier on it doesn't just double your risk, it creates an exponentially dangerous cocktail. Higher volatility plus higher leverage equals incredibly fast decay if you attempt to hold the asset long term.
So, bringing this all together, what's our final verdict on AAPU? As we've seen, it really is an incredibly powerful tactical scalpel designed specifically for day traders. Its defining advantage is that it safely captures max loss compared to traditional margin trading, which frees you up to make those high-conviction daily bets. But that exact advantage comes with severe structural flaws for anyone trying to hold it as a long-term investment. It's highly susceptible to the slow mathematical decay of volatility drag, and it carries an extreme vulnerability to a sudden tail risk wipeout.
Ultimately, these instruments require immense discipline and a truly deep understanding of market mechanics. AAPU absolutely gives you the ability to get double the daily action on Apple. But the final, most crucial question you have to ask yourself before ever touching a product like this is, can you actually handle double the risk?